everyone. Welcome to Leading Indicator, a show by Public.com focused on gaining insights from the very best macro minds. I'm your host this afternoon, JD Durkin. We are here with you today to discuss Jerome Powell's comments in Jackson Hole, the central bank and its path forward, and so much more. As always, don't forget to like, comment, and subscribe to our YouTube channel for more in-depth interviews that will help you keep up to date with the latest investment news. With me today, I'm very excited to say, is Dennis Lockhart, former president of the Atlanta Fed. Dennis, thank you for being here and welcome to Public.
Thank you, JD. Happy to be with you.
So, of course, at the end of last week, we heard from Chairman Powell at Jackson Hole in Wyoming. He warned, as many had expected, that further rate hikes may be a possibility. Inflation still too deeply entrenched for his liking, as we know. Should investors, you think, be worried about further rate hikes for the remainder of 2023 for the three remaining meetings between now and the end of the year?
Yeah, I think it's quite possible we'll see one more, and then after that, it will depend very much on the data. He keeps repeating the mantra of data dependent, and we should all believe that. So I don't believe there is any plan beyond the next meeting, really. But if I were to handicap it, I would say probably the October-November meeting might see one more rate hike. After that, I just don't know.
So that's kind of your base case for now. Maybe a pause for September, possibility for a hike for November 1st, and then back to a pause for December 13th, maybe?
Yeah, I'd say two things. First, I'd really characterize the September decision as a skip if they decide to do that. Then December is always a little bit of an awkward meeting to take policy actions because the markets get very thin toward year end and they're just not as comfortable with a December decision as they are October, November. So, again, I'm just giving you my sense of how this would play out. Probably skip September and one more hike October, November. After that, depends on the data.
Well, I'm sure our listeners and viewers would be very curious to know what your take is with regards to the highly touted Fed pivot, if there is one at 2024. Obviously, many data points between now and then, Dennis, but if you had to sort of give us some sense about when you think the central bank may begin cutting rates, what's your estimation for 2024?
I don't think the Fed's going to be inclined to cut rates until, and I'll use something very close to Jay Powell's words here, they are convinced that the disinflationary trend is sustainable and headed toward the 2% target. That doesn't mean they have to have achieved 2%, but it does mean that they've got to be convinced that the momentum is almost irreversible in that direction. I think it may take some time because I think the so-called last mile may turn out to be quite difficult. So I would argue that 2024 could be a hold period, or at least for most of the year. And then I think they'll be calculating the need for rate cuts based upon the overall stance of policy, including how restrictive policy is if having held rates at the current or even higher levels with declining inflation. So real rates would be increasing. And that will be part of the calculus in 2024.
The popular mantra is don't fight the Fed. However, Dennis, I'm sure you know that many market participants the last year to year and a half have very much tried to fight the Fed, not always believing what Chair Powell and his voting colleagues at the FOMC have had to say. Do you have every reason to believe, do you have confidence that when Chairman Powell says the inflation target is 2%, that is what the central bank will see through, that they say the job is not done until we get to 2%?
As long as he's in the chair, I think that is the position. The question of raising the target might come up, but it's not going to come up and be seriously engaged while Jay Powell's chair. That's, I think, pretty obvious. He couldn't be more definitive in taking that position. It continues to be a discussion, no doubt, and I think some members of the committee may begin to talk more in ranges that they're comfortable with, but the official changing of the inflation target, I just don't see it. I think Powell has taken his position on that.
Powell's also taken a lot of heat for the transitory phase of things. You might remember that a few years ago.
Mm-hmm.
And I'm curious for people that watch this from the outside, and many have criticized the central bank for that era where they said, hey, we believe that many parts of inflation are simply transitory and perhaps we're a bit late to the game to raise interest rates. But you've had such a unique experience. Talk to me about what you think the thinking was from someone like Chairman Powell at that era, and how do you think that we should view that phase of the Fed's public posturing?
Well, I think economists in general, and certainly the economists at the Federal Reserve, didn't have a deep understanding of the supply chains of the world. And so the argument that supply chains would snap back and therefore it was a transitory period of inflation was plausible at the time. It just turned out to be wrong. I think the reality was simply far more complex and far more challenging than anybody anticipated. So I have to fault them for misreading the transitory nature of inflation at that time, but I do credit them for moving quickly once they recognized their error and pivoting to a rate increase cycle, and we've seen that, and so shame on them for not understanding the supply chain better. But I don't think anybody in the world understood the complexity of that question.
Dennis, one of the most important pieces of data between now and the next Fed meeting will actually get here pretty soon. PCE, personal consumption expenditures. We did see that number increase by 3% in June on an annual basis. For people that do study the ins and outs of inflation, right, but whether it's CPI or PPI or PCE, why, from your perspective, is PCE the top dog when it comes to Chairman Powell and his colleagues' inflation consideration?
That's a very interesting question because I don't think the evaluation of inflation is as simple as looking at any single indicator. And so I think to keep the communication simple for the public and to some extent the financial markets, they continue to look at core PCE. I remember the meeting in which the decision was made, and Ben Bernanke was the chair at that time. And after we had decided on moving forward to become an inflation targeting central bank, Chair Bernanke said, I prefer the PCE deflator as our kind of our signpost. The reality, in my opinion, is that most members of the committee look at a dashboard. And on that dashboard are 15, 20, maybe even more indicators or cuts of the inflationary data. And from that, they pull together a synthesis of what the underlying inflation pressures are. It's not as simple as just core PCE.
Investors sometimes focus on interest rates as the only aspect of monetary policy, away from just the interest rate side. I'd love to get your stance on the strategy from the Fed in terms of quantitative easing, as well as quantitative tightening. I think this is something that if you go back just over a decade or so ago, maybe it was kind of experimental for the central bank, and it obviously does not get the headlines and attention of pure monetary policy. But how would you evaluate the work of this modern era, of this COVID era of the last few years of QE and QT, I wonder?
Well, the committee has put the QT process or program in the background and are not really spending time on it. You'll notice that there was virtually no discussion of it in Powell's speech on Friday. I think that's the way they want it. They want interest rate policy to be front and center and quantitative tightening to be really operating in the background. What I find interesting in the last few weeks, you begin to see mention on the part of certain members of the committee that they might very well anticipate a period in which they're cutting rates while at the same time continuing to shrink the balance sheet. So two policy tools arguably working a little bit at cross purposes. And that to me was a new and interesting development. That tells me that they simply are uncomfortable with a bloated balance sheet and are very committed to getting the balance sheet down to a workable level. It'll certainly be much larger than it was in 2007 when I joined the Fed, but nonetheless far below the almost 9 trillion where the balance sheet peaked. I think there are many reasons for that. Part of it is simply the unknown factor of the influence of a very large balance sheet. But we should also remember that they're looking at operating losses now because of paying interest on reserves and because of the scale of the balance sheet, so the scale of bank reserves. And I don't think they like the optics of the central bank incurring operating losses. So getting the balance sheet down seems to be a priority that even won't change in the event of a pivot.
Dennis, some Republican candidates for president, including former Vice President Mike Pence and many others, have suggested that it's long time to do away with the so-called dual mandates of the central bank. In other words, just allow the central bank to focus on one component and Congress can focus on the other. What are your thoughts on that, as perhaps that idea looks to gain a bit more mainstream attraction over the course of the next year as this political cycle heats up?
Interesting question, and I don't like to get drawn into political crossfire at all, but let me say this: U.S. Central Bank, the Federal Reserve, is somewhat unique in having a dual mandate by law, statutorily. Most central banks are simply mandated to focus on inflation. If that were to change, it would be an act of Congress to change it. I'm not sure it would change much in terms of the sensibilities of policymakers as they try to pursue their statutory mandate. They would take into consideration the employment picture as an element of the health of the overall economy. So even with a single mandate, I think policy would not change that much. And so I'm not sure I see what the reason for making that change would be. And again, it's perhaps, in my view, an unnecessary expenditure of a lot of energy on Capitol Hill when there are other things, particularly fiscal matters, that they could address.
I appreciate your willingness to weigh in on that. Again, I think it's something that our listeners and viewers may begin to hear much more about in the months ahead. So I am grateful for that response. I wonder, given your experience and where you're positioned today, Dennis, what do you think we most get wrong, either about Jay Powell personally or about the Fed? I'm sure you're very in tune with business news and the headlines and the stories we talk about, but is there anything that makes you think you're not quite framing this conversation the right way?
Well, I'll say a couple things. I'm not sure I can actually nail an answer to that question, but I'll give you a couple of thoughts. One is we should not doubt the resolve of Powell as chair and the committee to conquer inflation and get down very close to the 2% target. And I've been watching the commentary on financial news for now a couple of years, and there's always a prediction of a pivot in the next few meetings and a loss of conviction about the achievement of the target. I don't think we should doubt the resolve of Powell and his Fed to finish the job, and he's been saying that very explicitly. You know, we should believe what he says. That's one point. A second point in framing the overall discussion of economic policy in this period is how novel the set of circumstances are, and therefore how little perhaps history of monetary policy is appropriate for evaluating an set of economic circumstances that actually originated in a public health shock that locked down the economy for some period of time, and then an enormous rebound once the economy opened up, with all of the demand that was associated with that and the supply chain problems, supply side problems associated with that. To me, that's a really unusual and novel set of circumstances. We have now a strong, apparent, strong top line growth momentum in the economy with full employment and disinflation. those don't seem to make sense, but it's because we're dealing with a novel situation. And so those are two answers to your question.
I appreciate that. Dennis, you are uniquely positioned perhaps to weigh in with a really good perspective on my next question. The Atlanta Fed GDP Now figure. You know as well as I do, when this
Mm-hmm.
number jumps off the charts as it does today at 5.9%, it is going to earn a lot of conversation. I'm curious what more you could tell us about that specific figure and how you think, given your experience at the Atlanta Fed, how should the rest of us interpret a piece of data like that obviously is going to jump off the page when we see it?
Yeah, there's a lot to be said here is in a very quick tutorial on GDP Now. First, I would not pay attention to the number until the second half of the quarter. It is a now cast, meaning it is accumulating the data as the data come in uh, and putting them into basically an algorithm or an equation that mimics the calculation of GDP. Uh, Obviously, early in the quarter, you don't have enough data for it to be meaningful. Only as you get toward the third month of a quarter should you begin to take the number seriously. Well, now we're just about in the last month of the third quarter. We're seeing 5.9%. I'd begin to take that seriously. Where the GDP Now number has been off in the past, it's often related to inventory investment or disinvestment, which is not picked up so easily in current quarter data. So when it's wrong, that's often the reason it's wrong. I look at the 5.9% that you cited and just say if it's half of that, it's still a very strong growth trend in this quarter, which suggests to me that the committee, the FOMC, has its work cut out for it because the economy is chugging along at a very brisk pace.
And we know what Chairman Powell has said with regards to below trend growth. One more question for you, if I can, sir. Do you
Sure.
see a recession coming? And if so, when?
Well, first, I think we need to define what we mean by recession, and I have a little bit tongue in cheek been referring to a hurricane scale. A Cat 1 recession is a lot different than a Cat 5 recession. I don't rule out that we'll see a mild and short lived recession that may come about. Probably it would be in 2024. It's certainly not going to be, I think, this year's too much momentum. So I can't completely rule that out. But the current state of the economy doesn't suggest that we're even near recessionary conditions. So if it occurs, it's likely to be Cat 1, not Cat 5, not something that's deep and terribly damaging, but rather short and mild, and likely in 2024 if it happens at all.
It's a fascinating conversation, Dennis. I'm very thankful for your time. I could talk about this stuff with you for hours, but we'll have to leave it there. This is Leading Indicator, a source of insight from the world's very best macro minds. My special thanks today to a very special guest, Dennis Lockhart, former president of the Atlanta Fed. Dennis, thank you.
Thank you, JD. I enjoyed being with you.